Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Hello everyone, Rahul Shah here, trying to make investing accessible and profitable for the average investor. You see, a lot of big YouTube influencers have been quite candid with the misfiring stock picks. They have come out with videos discussing their big losses and asking their readers to stay calm. I thought I will follow their lead. So in this video, I'm going to be discussing the stock recommendations that I have made since the start of this bull market, which is of course March 2020. As you'd be aware, the period between March 2020 and October 2021 was very good for the stock markets. The large cap indices saw a huge jump of almost 140%. The small cap and the mid cap indices did even better. However, the wheels started coming off a bit since October 2021. The market has been quite volatile since then and has come off significantly from its highs. Across a lot of stocks, the wealth destruction has been huge. So let's see how one of my services, that is Microcap Millionaires, has done against this stock market backdrop. Microcap Millionaires, that is MCM, has closed a total of 26 recommendations between March 2020 and May 2022. It has closed 22 in the positive and only 4 in the negative. This has given it a strike rate of 85%. Going further, the average return per stock that it has generated on all the closed positions is 70%, and the average holding period has been around 17 months. Now here are the details on the 26 stock positions that I have closed in MCM between March 2020 and May 2022. Graphite India has been the biggest gainer, returning 274% with a holding period of less than a year, whereas Navkar Corp is the biggest loser. I had to close this position at a loss of almost 50%. Now I'm sure you have noticed that there are a lot of mid caps and large cap names in here despite the service being called Microcap Millionaires. The reason is that in this service I look at the valuations first and the market cap later. So if a large cap is trading below its book value, I don't mind recommending it as it usually comes with a low risk as opposed to a micro cap, and therefore to that extent I am market cap agnostic. Now these are individual recommendations. However, what matters is how the service has done as a whole, and this slide will give you that answer. You see, as on March 20, 2020, MCM was a 2.3 bagger since inception, whereas Sensex was a 1.5 bagger during the same time period. By May 20, 2022, MCM had become a 4.5 bagger, whereas the Sensex had become a 2.6 bagger. Therefore, MCM gave a return of 94% between March 2020 and May 2022, whereas the Sensex gave a return of 68%. Therefore, MCM outperformed the Sensex between March 2020 and May 2022. Now, some of you may wonder, why have I compared the performance of MCM with Sensex and not with small cap or mid cap index? Well, the answer has to do with the goal of the service. You see, the goal of MCM is to outperform the Sensex over a long-term period by at least 5 percentage points per year. So if the Sensex delivers 15% per annum, the goal for MCM is to try and deliver 20% per annum at least. And this is why the performance of MCM has been compared with the Sensex and not any other index. Another important point worth mentioning is that this 94% return has been achieved by allocating at least 50% of the MCM corpus to fixed deposits at all times. You see, I don't believe in being 100% invested in stock all the time. I keep moving between stocks and fixed deposits in MCM depending on the broader stock market valuation. If the broader market is cheap like it was in March 2020, I may switch stock allocation to as much as 75%. And if the broader market is expensive, I will sell stocks and have as much as 75% in fixed deposits and only 25% in stocks. Right now, I am around 60% invested in FDs and about 40% in stocks. Here's a list of all the open positions that I have in the service right now. For obvious reasons, I cannot disclose the names of these stocks as they are still open. However, the worst performer is down 26% since recommendation, and there are only 4 stocks that are down more than 20%. which I think is a good sign. So that was all about MCM and its performance between March 2020 and May 2022. In case you want to know more, I am holding an emergency broadcast this coming Monday at 5 p.m. where I will discuss the strategy in detail. Please click on the link in the description box for more details. Now I also run another service which is a penny stock service called Exponential Profits. I define a penny stock as the one that's trading at a double-digit price. That is, stocks priced at Rs 99 or lower at the time of recommendation. This means the price can be as low as Rs 5 and as high as Rs 99. So with the definition out of the way, let us take a look at the performance of this service during the same period, that is March 2020 and May 2022. Happy to share with you that here I have a success rate of 100%. I have closed a total of 29 positions between March 2020 and May 2022, and every single one of them at a profit. Of course, the fact that markets were in a bull run helped a great deal. The average gain per stock stood at around 82% and the average holding period was 10 months. An 82% profit for a holding period of 10 months is not bad at all in my view. Here's a detailed breakdown of all the positions closed in Exponential Profit since March 2020. Precision Camshafts was the biggest gainer with gains of almost 177%, whereas Orient Abrasives returned the least at 22.2% gains. And right at the bottom are average gains per stock and average holding period. As far as the performance of the overall service is concerned, the service has returned almost 130% between March 2020 and May 2022, as opposed to 87% returns given by the benchmark index. So once again, the service has outperformed the benchmark index. Exponential Profits has earned a return of 128% between March 2020 and May 2022 versus 87% earned by the benchmark index. You see, like Microcap Millionaires, Exponential Profits also has a fixed deposit component and a stock component, and right now the ratio between the two is around 50-50. That is, half of the corpus is invested in penny stocks and the other half is parked in fixed deposits. Therefore, this 128% returns have been achieved by staying 50% in FDs on an average, which makes it even more noteworthy in my view. As you can see, there are 16 stocks that are in open position right now, with the biggest loser at the bottom of the screen down by 29% and the biggest gainer is up by 57%. Now here are the two performance tables once more. Between March 2020 and May 2022, Exponential Profits has earned 128% versus 87% for the Sensex, and MCM has earned 94% versus 68% for the Sensex. In conclusion, here are the things that have worked for both the services and helped them earn market-beating returns. As I said, I do not believe in being 100% in stocks all the time. Back in March 2020, when the markets crashed, both the services were sitting on a lot of cash, which allowed me to recommend a lot of stocks close to the bottom of the stock market. Likewise, as the markets turned expensive, we reduced allocation to stocks and are currently sitting in cash to the tune of 50% to 60% of the overall corpus. The next point is about staying clear of toxic stocks. You see, companies that are loss-making and have a lot of debt on the balance sheet are a strict no-no to me. I need my stocks to be fundamentally strong companies with a long history of profit-making and a balance sheet with very little debt. Insisting on these qualities has helped the services to avoid big losers in the recent stock market crash. I have also steered clear of expensive stocks where people were willing to pay 60 times, 70 times, even 100 times earnings to good quality companies. I am of the view that paying a very high PE multiple is as bad as investing in a toxic stock, and you are more likely to lose money in both the cases than make any decent profits. Now that a lot of high PE stocks are correcting, we seem to be having the last laugh as we never recommended such companies. Next point is about having a clear sell plan. I think this is another important rule where we are not a buy and hold investors. We believe in holding on to a stock for a maximum of 2 years, beyond which most likely we will exit the stock. As you can gauge from the average holding period, we don't tend to keep a stock for long. As soon as the stock doubles from our recommended price, we liquidate the position, no questions asked. Of course, we have missed quite a few multi-baggers by doing so, but we are more comfortable sticking to our approach as it has worked for us. Last but not the least is discipline. I think in investing, discipline matters more than intelligence, and if you are disciplined and stay within your circle of competence, there's a high chance you will end up making money over the long term. So there it is, my performance track record in the current stock market cycle so far. You can post your queries in the comment section and I'll be more than happy to answer them. Also, please do not forget to share and like the video in case you found it useful. I will see you again next time. Thank you so much.